This past month in August has been such a crazy month for the stock market, from the S&P 500 hitting new all-time highs to both Apple and Tesla announcing stock splits that sent both of their share prices flying. What's up guys, Jose here. In today's video, I will be going over my top 3 stock picks for the month of September. I've done my own research for you guys and have composed this list of stocks that I believe will see big growth in the future. So if you guys are interested in making some money, make sure to stick around all the way until the end, as well as smash that like button and hit that subscribe button if you haven't done so already. Some quick things to take note of. This first week will be extremely important due to economic reports, and the one that many investors are keeping their eye on is the August employment count that will be released this Friday. As good as August was for the stock market, September has historically been challenging, but stocks can still carry momentum from last month from what looks like to be the best August for the S&P 500 in the past 36 years. Economists are still a little bit more optimistic about economic data in Q3, but one thing that they are a bit concerned with is the job market, since around 1 million people are still filing for unemployment every single week. There's also tons of bullish sentiment going into this month because Papa Powell has repeatedly stated that the Federal Reserve would be willing to keep the money printer running hot and temporarily letting inflation rise above 2% to help out the economy and the job market. Also, be prepared for the ongoing excitement throughout the whole month of September around the market's 2 favorite stocks, which we all know are Apple and Tesla. Apple has begun trading after a 4-for-1 split, and Tesla is also trading on a split adjusted basis to start the month off after it split its stock 5-for-1. Apple choosing to split its company shares changes its weight in the Dow, so the index is being adjusted, and there has also been some new faces added to the Dow Jones, while 3 have been removed from the index. ExxonMobil, Pfizer, and Raytheon will be replaced by Salesforce.com, Amgen, and Honeywell. So now that I've covered some things to keep an eye on for the month, let's get started up. For my first company on this list, we have Cisco Systems, ticker symbol CSCO. This is an American technology conglomerate that develops, manufactures, and sells networking hardware, software, telecommunications equipment, and other high technology services and products. This is the worldwide leader in networking for the internet. Their networking solutions connect people, computing devices, and computer networks, which allow people to transfer information without regard to differences in time, place, or type of computer system. Basically, about 85% of internet traffic travels across Cisco systems. Currently, Cisco is trading for around $42.20 per share, and when looking at Cisco's 52-week low, it was sitting around $32.40 per share and reached a 52-week high of $50.30 per share. Cisco has also been around for quite some time, since 1984, and they currently hold a market cap of $178.1 billion. As of right now, Cisco has a price to earnings ratio of 15.98, which in my opinion makes this company a pretty good deal, not to mention that they also pay a nice dividend yield of 3.41%. They also have a current price to book ratio of 4.71. Now let's look at how profitable this company actually is. When looking at Cisco's financials, they have a profit margin of 22.75%. Their management has been doing pretty solid since they have a return on equity of 31.37%. Diving into their balance sheet, they have a current ratio of 1.72, which is very strong. As all of you guys know, I'm not a professional, so I always like getting a pro's opinion on the value of a company. And according to Morningstar, fair value for Cisco stock is around $48 per share, which is currently higher than what the stock is trading for. In the past year, Cisco has sort of been in a downtrend and has not fully recovered to its pre-pandemic levels. Here's why I really like Cisco right now. Analysts are projecting $3.33 per share for Cisco in 2022, which means when you divide the stock price over its earnings per share, you get a price to earnings ratio of 12.69, which is definitely lower than the S&P 500 and other competitors within its industry, such as Microsoft and Zoom. On August 25th, Cisco recently agreed to buy Babel Labs, a company that uses advanced AI technology to distinguish human speech from unwanted noise. It would reduce background noise and enhance the voice to elevate communication, which would overall enhance the quality of Cisco's video conferencing conferencing application. So since Zoom stock has soared over 300% this year, it could really struggle to maintain that momentum after the pandemic passes. And with Zoom also having some security issues, this could push consumers towards more experienced technology companies like Cisco and Google. And if Zoom's growth slows down as Cisco and other competitors continue to upgrade their video conferencing platform, Zoom could have a really hard time justifying the stock's forward price to earnings ratio of over 1,700. Cisco is a very mature company that has been around for quite some time. Even though this company is not a dividend aristocrat yet, they're going on 9 consecutive years of dividend growth, with already having increased its dividend in 2020. Their 3-year dividend growth is almost 9%, with an over 12% dividend growth rate for 5 years. This means they might grow their dividend 3 to 5% for the next 1 to 3 years again. The next one here on my list is Rocket Companies, ticker symbol RKT. This is a holding company that is based in Detroit and owns Rocket Mortgage, Rocket Home, and Rocket Auto. There's plenty of others, but this is just to name a few. Rocket is very popular in the mortgage industry, and they're making mortgages more of an online process. This company just recently IPO'd a few weeks ago and just started selling its shares to the public. Rocket Companies went public at $18 per share and is now trading at around $28.42 per share. They have a 52-week high of $29.96 per share, and RKT has a pretty big market cap totaling up to $56.3 billion. Since Rocket Companies just went public, there is not too much financial data to look at to evaluate this company. No price to earnings ratio, dividend yield, or price to book ratio. This company has been listed for about a month now, and since then, its stock has continued to keep climbing and is sitting around its all-time highs. Throughout the past 12 months, they have had $6.01 billion in revenue, and when looking at their balance sheet, they have around $3.5 billion in cash reserves with an impressive ratio of 4.11. Rocket Companies has been able to keep increasing their revenues in the past years, and they're coming very close to reaching $1 billion of earnings this year. The mortgage market is very strong since interest rates are very low and there's way more buyers than sellers of properties. With more people purchasing homes, there's certainly going to be an increase in refinance and mortgage loans, which is great news for Rocket Companies. Rocket Companies is doing very well right now, and they're a solid mix of a financial company and a technology company. Not too many people do online mortgages, but honestly, they're very convenient and I could certainly see them catching on. This company is already doing very well and only has room to grow from here. During last year in 2019, this company reportedly profited over $900 million of their total $6 billion revenue. With this year seeing a record high number in mortgage applications, Rocket Companies is expected to post an even bigger profit than they did last year. They will also be rolling out a dividend, and this will surely help out the fundamentals of the company's stock. Overall, this company has been around for a very long time and still has tons of room to grow ahead. This is why I really like this company, and I think it's one you should look into for the month of September. Finally, for my third and last pick on this list, we have DraftKings, ticker symbol DKNG. DraftKings has done something very unique because they have been able to transfigure the gambling world from real sports, fantasy sports, and casinos as well. DraftKings has created a way for everyday people to gamble and bet on their favorite sports and teams, all from the comfort of their own home. They have made it so simple that even a little kid could do it. And as of today, DraftKings stock is trading at around $36.32 per share, with seeing a 52-week low of $9.84 and reaching a 52-week high of $44.79. The company currently has a market cap of $12.85 billion, and they have no price to earnings ratio since they have not been profitable. They pay no dividend and have no price to book ratio as well. DraftKings is taking quite a hit right now in terms of their profitability since they have a profit margin of negative 88.19% and no current return on equity. Looking at the company's balance sheet, it's unsure how much current debt they have, but they do have about $1.24 billion in cash with a current ratio of 5.38. Looking at how the stock has performed since its initial IPO, the company started trading at $10 per share. Since the March market crash, DraftKings has been growing at a very steady pace. Most companies were not doing good after the crash, but DraftKings is one of the few stocks that has absolutely been on fire. With most professional sports being postponed or canceled canceled in some way or another, DraftKings stock has still continued to grow. And when getting a professional analyst view on the stock, Morningstar has DraftKings valued at a fair value of $45 per share, placing it higher than what it is currently trading for. So how does DraftKings exactly make money? They make most of their money through daily fantasy contests, so users will pick a group of players from a specific sport and compete against other users to see whose team scores the most points. The event payouts actually comes down to how many people actually enter that event, and then DraftKings will take a certain percentage for them. The way this works is, let's just say 50,000 people enter an event and each of them pay a $25 entry fee. This will add up to a total of $1.25 million, and then DraftKings will take a certain percentage, making the prize pool $1 million. So the more people that enter an event, the more the payout will be. They already have 720,000 monthly users, which is up from 620,000 from this same time last year. The average revenue per user has also gone up to $41 from $37 a year ago, despite the pandemic. With more people staying at home and many casinos still being closed, DraftKings has a great opportunity to increase its engagement with millions of potential customers as pro sports are getting started back up. DraftKings has not yet been approved in all US states, but there is hope for legislation that would allow them to operate across all US states. The increase in their availability would allow them to bring in more players and advertise on a national level. This will increase their revenue and reduce their marketing expenses, making it a win-win scenario. So I'll admit, this is a high risk, high growth stock. With basketball and baseball making a comeback already, there's no guarantee that they will be able to finish out the season without any more shutdowns. They also need more states to start legalizing sports betting before it can have access to more customers. But in my opinion, the potential payoff from this stock can be huge, which for me makes taking the risk worth it. Just some things for you to keep in mind. We're going through a very odd time right now. The stock market in itself has just reached new all-time highs, with the S&P 500 setting a record level in August. So that means that things are starting to look better, right? Well, not necessarily, since about 60% of stocks are still at a loss. Even though the stock market is always forward-looking, many analysts are still having a tough time believing that this stock market rally is justified and real. In my opinion, the stock market and reality are on two completely different pages. This is why I advise doing your own research before investing into anything, and I highly recommend you do not invest any money that you're going to need for the next 3 to 5 years, because with all the volatility and uncertainty, the stock market can go back down as quickly as it came up. I am not a professional, so make sure you use these videos as a guideline for your own research and for entertainment purposes only. Thank you guys so much for watching today's video. If you found any value whatsoever, make sure you smash that like button and hit that subscribe button for more future content like this. I like to make a ton of videos about making money online, investing, entrepreneurship, finance, and many more. I'll see you guys in the next one. Peace.